Okay, hi and have a good day, everyone. So today, if you see here, I record it after 12 in the middle of night, and the date is a bit late for me to record the video. To share with you. Okay, but don't worry. Later, I will replace for all of the things that I miss. Okay. So basically, this chapter four, actually, I have already start teach a bit before inside the class, but because one of you didn't come to the class, so I just like teach half of it. So today I will repeat it again, starting from the first slide, to make you have a better understanding about this chapter lah. Okay, so basically this chapter it is about theory only. It is about financial marketplace and also investment products. Means what type of investment you have. You're supposed to invest in common share, preferred share, mutual fund or whatsoever. You will learn from this chapter. Okay, there is the three factors that will affect investment strategies. Means you want to invest, so you need to consider these three factors lah. Okay, which is the first thing about the safety and the risk of your investment. How safe it is. How much the risk contained from your investment. Okay, and then you need to learn also factors. One of the factors, second factors, which is components of the risk factor, and then the third one, investment liquidity. Investment liquidity. Liquidity means it's like in Malay it's like cair. Cair means here the ability for you to sell or to buy your share quickly. Means the liquidity depends on how fast you can sell or you can buy your shares. Okay. Okay, now we will learn about the first factors, which is safety and the risk. Safety, how safe your investment, how risk your investment. So safety ni, it is about the minimal risk or loss in investment. Means you want to minimum the risk in your investment or minimum your loss in that investment. Okay, eh? And then for the risk measure of uncertainty. So the point here, it is about uncertainty in your investment. So we call it as the risk lah. Okay, and then the range of the risk between very safe to very risky. Okay, so I provide you here the example of safe investment and also high risk investment. Safe investment, it is something like saving accounts. It's like every month you put some money inside your bank. Okay, because it didn't involve too much risk. Okay, it is safe for you. Okay, saving accounts, certificates of deposit, government bonds, and certain corporate bonds, stock, and also mutual funds. This one, it is about the safe investment. Okay, about high risk investment, you can say it is about the speculative investment. Okay, because of what? You involve in this high risk investment with the hope that you can earn large profit in a short times. Means here, high risk, high return lah. Okay. High risk, high return. So we call this one as a speculative investment. Okay. Because of what? Why you involve in with this high risk? Because you have the hope of earning a relatively large profit. You want high return. Okay, high return with the high risk. Okay, we're still in the first factor, which is safety and risk. Okay, so now investment, this is like you can say uh, choice factors that related to safety and risk that can affect the choice of investment. Means you want to invest in low risk, invest in high risk. Okay, so how you can say factors? What type of factors that will involve with lower risk, and then what factors will involve with higher risk. So with lower risk, it is like people with no financial training or investment background. Means it is like a person with other background, not too expert in the financing, not too expert in accounting. So because of these people, they have no background, so they will invest in lower risk compared to higher risk. Okay. Other than that is all the investors. Okay, all the investors means already involved with investment long time ago. So because these people already involved with maybe so many types of risk, so they want to involve with lower risk now. So older investors lah, okay, because they have so many experience and everything, so they just want to involve with lower risk. Other than that, lower income investor, okay, because of this investor have lower income, or the income is not that high for them to invest in the higher risk, so they involve with lower risk lah. Because if anything happen, it will not affect them too much. Because of what? Because they involve with lower risk only. Okay. Families with children, okay, because there is too much risk for them to involve with higher risk. That's why they involve with lower risk. Because of what? Because they have children, they have families, they have relatives, and so on. So they don't want all of these, investment with high risk to affect their family. So they involve with lower risk. Okay, the last factors, which is employees worried about job loss. Means, okay, these employees, they just involve with investment for fun. It's something like for fun. That's why they don't want to take high risk. Okay, it is just lower risk for them because of what? Because they are worried if they will lose their job. Okay. Investment with higher risk, investor with financial training and investment background. Means this investor have already expertise, okay, in investment. Means the selok belok and everything they know already, so that's why they involve with higher risk compared to the lower risk. Younger investor is that investor maybe just involved with the investment. We can say not just involved, but not that investors with too many expertise or uh, experience, or something like experience. Okay, if all the investors they have experience already, that's why they don't want to involve with higher risk. Okay, but younger investor, they just, you can say, they just get involved with investment. That's why they want to try new things to invest with investment with higher risk. Higher income investment investor means this investor, they have, we can say, many money, much money. Okay, rich, something like rich. Okay, means if anything happen to them, it will not affect them that much. Because of what? Because they have higher income compared to lower income. They will invest in lower risk. Okay, single individuals or married couple with no children means if anything happen, it will just affect them, not their relative, not their family members. That's why they involve with higher risk investment. And then the last one, employees with secure employment position means if anything happen, they still work with their current job. Okay, either they lost their investment or they got a higher return with their investment. Anything happen, it will not affect them because they have secure employment position. Okay. Okay, now we'll proceed with the second factors, which is component of the risk factor. You need to know what type of risk factor. Okay, what type of risk, which is inflation risk, interest rate risk, business failure risk, and market risk. Means if you involve with investment, this type of risk you need to know lah. Okay, if anything happen to your investment, you have already know risk that you will face. Okay, so this is the four type of risk: inflation risk, interest rate risk, business failure risk, and also market risk. Okay, if you see inflation risk, it is about inflation. Okay, which is the situation rise or increase in the general level of prices. Means the price going to be high. So what will happen? You need to consider that. Okay. And then here, why you need to consider inflation risk? Because if the inflation happen, there is a risk that the financial return will not keep pace. Okay, maybe at the beginning of the year you expect this is the return you will get, but at the end of the year it might not happen like as you expected at the beginning of the year. Because of what? Because of inflation. Okay. The second is interest rate risk. Interest rate lah, interest rate like bank charge you or anything lah. This one is just the general. I want to tell you something like charge lah. Okay. So this one associate with preferred stock or government or corporate bond is the result of changes in the interest rate in the economy. If anything happen to economy, which is interest rate, so it will affect your investment. That's why you need to consider the interest rate in the economy. Okay, because of what? Because if the interest rate increase, the value of your investment is decreased lah. Okay, for example, you borrow money from bank for you to invest in ASB. Okay, so now different bank they charge different interest rate. Okay, if the interest rate by my bank is higher than interest rate charged by CIMB, so it means here you will get higher return if you invest in CIMB. Because of what? Because CIMB charge interest rate that not much higher compared to my bank. It's just the example. Okay. Other than that, business failures. Business failures means kegagalan you punya business. Okay. So here, associate with investment in stock and corporate bond or mutual fund that invest in stock or bonds. Means here, you invest in the company that will invest again in another stock. Okay. For example, here maybe you invest in Bursa Malaysia. Why Bursa? No. Maybe you invest in Sime Darby. Okay, Sime Darby. When you invest in Sime Darby, and the Sime Darby will use your money, for example, again, to buy another share from another company. Like example lah. So that one, higher risk lah. Okay, because of what? Because of the possibility of bad management, unsuccessful products, competition, or a host of other factors will cause the business to be less profitable or experience a loss. Okay, so there is the factors that you need to consider, like maybe bad management, or maybe the product unsuccess as you expected, or maybe too much competitor in your business sector or whatsoever. There is will cause you to face business failure. Okay, so you need to consider. And then market risk. Economic growth is not a systematic and predictable. Means you cannot expect anything happen in economic growth. Maybe at beginning of the year you expect it's going to be smooth. By the end of the year it might be lost. Which is you are not predict of that to happen. Okay, not systematic and not predictable. So the price of the stock, bonds, mutual funds that invest in a stock, bond or other investment may also fluctuate because of the behavior of investors in the marketplace caused by political or social conditions. Means maybe anything happen, politic or maybe social condition that you didn't expect can cause you in your investment value. Okay, so it's not predictable.